Hey guys, welcome back to the Capital Mindset Show. Today we're going to be going over a requested company, Church & Dwight. So this company, I'll show you guys here the price action over the past 5 years. It's been more or less in line with the index. If we include dividends, it comes really close still. So this is a company that many dividend investors are actually excited about for the dividend growth prospects. Currently supporting a 1.19% dividend yield, a PE ratio about 28.05. We're going to delve a little bit deeper into that as we go along. Let's go over to the website to kind of familiarize ourselves with some of the brands here. So you probably know some of these brands here. We have Waterpik, Flawless, Trojan, OxiClean, and then we also have Arm & Hammer. So Arm & Hammer, remember in marketing, for example, we have breadth and depth. So the depth is the variations of each product. So that's actually a really good example. And then as we see it actually laid out horizontally, that's a good example, or basically how our minds can think about it in terms of breadth. So they have actually a variety of different brands. And then underneath, for example, the Arm & Hammer brand, they have, toothpaste, cleaners, etc. So something I want to also kind of highlight with something like Arm & Hammer is, it has a lot of staying power, and with branding, we should be seeing that over this inflationary period, they are able to pass on the cost to consumer. Now, something that I'll kind of note, there's another company or other companies, let's not point to one specifically, but for the most part, consumer packaged good products are pretty good insulators of inflation up to a point. It depends on the strength of their brand, really. But you might notice that, okay, well, the product that you bought last year went up about 10 cents, 20 cents. And it doesn't seem like a lot in absolute terms, but in percentage terms, it can be actually a decent chunk. And so that's basically what a lot of investors look to for these companies, a little bit of inflation resistant. They also call them, consumer non-cyclical businesses. So, Procter & Gamble, which is like the creme de la creme of this sector, but, Church & Dwight's pretty good too. We'll look at some metrics there. Now, let's go over some of these. Let's go over actually their PowerPoint presentation. And this is going to be kind of the sales pitch. This is what the company wants us to see in order to convince us to invest in the company. So let's go over some of this stuff. Okay, we have gross margins actually showing that, organic sales are growing and gross margins are improving. Okay, so what I'd also see is that marketing spend is flat year over year, and also SG&A is actually down a little bit. So okay, they're becoming a little bit more efficient, a little bit leaner. Operating margin is up 50 basis points, and EPS grew by 8%. So far, so good. What I want to highlight is the internationalness of this company. We often like to highlight when a company is international. You don't have to invest in international stocks to get international exposure, at least to other currencies. Now, if we actually take a look at this company, it isn't super international like other companies. We'll take a look at in another video, Clorox, which has a little bit more. But Church & Dwight has 76% domestic, 18% international, and then we also have the 6% specialty division. But focus on the 76 domestic, 18 international for this argument here. And what they mean by international is typically Europe. That's what they're really meaning here. Now, domestic, they mean Americas. Okay, so they also have a diversified product portfolio. What they're kind of telling us here is 60% of their products are on the premium brands, 40% are on the value side of things. Okay, so they're going to have higher margin on the premium side of things, lower margin on the value side of things, but they're going to probably move more volume, so to speak. Okay, if we take a look at some of these other metrics that they're showing us here, this is kind of showing the power of their brands. Of course, they're going to highlight this to us because, again, as an investor in this kind of business, the brands are everything. The strength of these brands are everything. If brands are, the company with the weaker brands is going to lose in this case. And then we would want a bigger discount on that company rather than something like, again, let's compare it to the king, Procter & Gamble, which has the best brands, we could say, or something like Unilever, which also has really good brands. There are actually a couple. L'Oreal is another one that has really good brands. And now we see some of this. This is kind of like the bragging rights that they have, in hindsight, that they acquired all of these brands over a long period of time, and they've kind of tucked it into the business, kind of showing that they are really good at mergers and acquisitions, that they're not wasting your money when they do that. They're not simply empire building. And you can see, again, what they show here is they're trying to tell you, okay, and this is important, by the way, for us as investors, because oftentimes we're going to find companies that are liking to empire build. So they're just trying to buy up a bunch of companies and trying to, grow that way. And that can be very addictive. A lot of people talk about how mergers and acquisitions can be a very addictive process for management, and we would rather see companies grow organically rather than relying on mergers and acquisitions. Okay, so You can see that all the way back to 1846. That's when they started with Arm & Hammer. That's why I was highlighting. Arm & Hammer is what started everything. Okay, so this is again, yeah, it's the same story here. Acquisitions and acquisition criteria. Again, see why it's important. Okay, so they're really highlighting that because that's a big part of their strategy. They're very acquisitive in nature. Okay, and it's good. It's good. Okay, so that's their environmental goals, trying to become more efficient. All well and good. And we already talked about some of these. We'll talk a little bit more about them in this part. This is, of course, a big highlight for dividend growth investors. You can see 4% dividend increases in 2022, but you can see they're showing you, okay, over the past 5 or so years, we've been growing the dividend each and every year, and those are the percentages we grew it by. So if you're a dividend growth investor, you're looking at this and you're saying, heck yeah, okay, they have 121 years of consecutive dividends, not dividend growth, dividends, okay? So I don't think they're a dividend king as of yet. Okay, and a dividend king is a company that raises its dividends for 50 years or more. Okay, now let's go over to the financials for Church & Dwight, and this is their 10Q. So this is their most recent up-to-date for their balance sheet. Now, remember, for their income statement, it's not going to show the full year. It shows at most the 6 months there, ending in June 30, 2022. We compare it to the prior year, and I'll zoom in for you guys so you guys can see a little bit better. But we compare it to the prior year, we do see that they are still managing to grow. Marketing expenses actually went down, which is, again, what they were saying or telling us in the presentation, that they're becoming a bit more efficient. They're holding back on that spending. They're also coming down in not administrative expenses, the marketing expenses. Okay, so they improved on some aspects and some things a little bit worse. But selling, general, administrative expenses, those went up. Okay, but we can't really blame them for that, considering the environment that we're in. Okay, something has to be going up too, right? So the cost of sales is reflecting the gross profit at the end. You can see it at the line item. So they're actually making less in gross profit with elevated sales. That's where we're seeing that inflation. So the cost to produce the product and how they're recognizing that inventory cost. So I don't know how they're scheduling it, either FIFO, LIFO, or weighted average. I don't know. They'll actually tell you somewhere around here. But the point is, we are seeing costs rise, and with costs rising in the cost part of the mix, then we're going to obviously see gross margins come down. So that's nothing to be, that's nothing crazy. Okay. Now, if we go to the statement of cash flows, the balance sheet first, then the statement of cash flows, we are going to see that, okay, they have an improved cash net position, about $639 million versus $240 from the previous year. Okay, all well and good, but they could have gotten that from debt. We do see that debt has risen a little bit from about $1.6 billion to about $2.1 billion. And we also taken a look at some other, so this goodwill, we know they're very acquisitive. It is a big portion of the balance sheet, but not a stupendous amount. It's not the craziest amount. Okay, so their financial position is solid. It's nothing that I'm really concerned about. Now, of course, if there ever is some kind of inventory issue that, they're not really exposed to that too. It seems like their inventory levels are pretty controlled. They're managing a tight ship. Okay, now let's go to the statement of cash flows. And of course, they're profitable from a net income basis, and they're also, cash flow positive. So solid company all the way around. Nothing really to complain on my end on this part. And so with Church & Dwight, we're going to take a look at some of these other aspects. And kind of coming across the evaluation here, we don't really have to continue forward before understanding that it does appear that the company is a bit pricey. It's on the pricey side. So a lot of the qualitative aspects are what the market's kind of paying attention to here. The safety, perhaps, and as well as the ability for the company to, again, provide value to shareholders in the form of dividends and, some here and there, like buybacks. But for the most part, the company, it's not going to make you incredibly rich. It might, unless it remains elevated at current multiples and, nothing ever bad happens to it and, it just continues to grow and the market rewards it with the same multiple. You could make that argument. I don't really like to make that argument, but you can make that argument. All right. So basically what it's priced for is, and we're basically putting no discount whatsoever. We'd have to grow at about 12%, which is a bit on the higher end of what they've been expected. If we actually look at what analysts are estimating that revenue does come down a little bit, but cash flows are also estimated to rise a little bit there. Now, if we look at buy or the ratings by analysts, we have a strong buy rating according to analysts with a price target of about $103.98, implying a 17.82% upside from there. Okay, so some of these other metrics, we have return on invested capital looks pretty solid, return on equity looks really solid, return on assets also looks pretty solid. Okay, some other qualitative aspects, we do see that, you know, the book value per share is about 14.65, not too important for something like this, and we do see a very conservative dividend payout ratio, about 28.29%, or a dividend payout rate. So again, the model's not actually picking up any risk of bankruptcy for this company. Makes sense. We're looking at a solid business at the end of the day. I'd be very surprised if it measured anything else other than that. We do see that they have been buying back shares here and there over the course of the past decade. You know, nothing major. They're not like cutting shares in half, but they're buying back shares. Okay, they're doing something. So all in all, with what I see with Church & Dwight and what we'll see with Clorox in the next video is, okay, solid business. What I want to pay attention to this personally. Like, this is me. I'd pay attention to it. If it ever gets into a price point where I'm interested, I'll kind of come in and nibble it, or maybe, you know, build it into a position. It is a business that you could probably say you could sleep well at night, given if you get the right price for it. Of course, now the discussion can kind of delve upon, okay, well, if I'm getting the right price for it, maybe something bad's happening. Yeah, that's very valid too, because, you know, it's priced right now because the market's rewarding it for its high quality. If, you know, tomorrow, what's going on in the world, you know, maybe it's a broad market sell-off, but if it's selling off by itself, that maybe there's something wrong with it, and then we're gonna have to kind of dig a little bit deeper. We're gonna have to do that, but it's not like a question. We're gonna have to see, okay, well, what is the market pricing in here? What are they concerned about? Is this a problem? Yes or no? And then we can make a decision from there. With that being said, guys, thank you guys so much for watching, and make sure to check out the video if you guys are interested in the Clorox or my take on Clorox. But that's my take on Church & Dwight. With that being said, I'll see you guys in the next one. Bye.